When the market falls, such as they have in September and October, we need the subsequent rallies to do certain things. And the question is, did the NASDAQ make the right moves on Monday and Tuesday to warrant further bullish action, or is this just a Wall Street trap? Hello ladies and gentlemen, welcome to the daily recap show where we talk about stocks and the financial markets. If you like this video, please subscribe, hit the notification bell, let's get into it. And it seems the bulls are back. Technology, communication services, defensives, healthcare, financials, cyclicals, industrials, utilities, materials, everywhere was green except energy. These guys got sold and they continue to get sold, and we're going to talk about why. Looking at sector performance, we saw energy, the only red sector. Other than that, it was just green all around, with utilities outperforming as well as comm services. When we have huge bullish days or huge days during the market, sometimes it's always good to take a step back, have a look at the bigger picture. And this is the sector performance for the last year. We can see right here, the best performing sectors continue to be XLC and XLK, which largely is just technology as a whole. We got Google and Meta and XLC. XLK is Apple, Microsoft. A lot of the big names are in here. Gold miners, GDX, plus 21% for the year. And we can see here that solar, XLU, and real estate are the worst performing sectors for the year. So even though utilities was the best performing sector for the day, still one of the worst performing sectors for the year. Looking at commodities, we saw crude and Brent move a lot lower on the back of poor demand, especially in Europe. Gold didn't do much on the day, as well as silver was down 0.5%. Now let's move on to yields. Now this is the entire curve from the 3-month to the 30-year. The short end of the curve, the 3-month to the 2-year, hasn't really moved much in terms of basis points, whereas the longer end of the curve have increased, anywhere from 25 to 40 basis points. So the yield curve is slowly uninverting. But if we actually have a look at what yields did on the day, the short end of the curve, the 2-year and the 3-year and the 3-month did outperform, but the 10-year and the 30-year did underperform. Earnings, big day for earnings. We had Microsoft report, Google report, we had Visa report, and we're going to go through these 3 companies. Tomorrow we have Meta, Boeing, IBM, T-Mobile, Hilton Hotels, some very big names out here, but particularly Meta, IBM, and Boeing probably account for about $1 trillion in the S&P market cap. Moving on to the implied moves, we saw Google was actually down about 6%, and we can see here that the implied move for Google is about close to that plus minus 6%. Microsoft was up about 4.5% after hours, and again the options implied move is right here at about 4.5%. So the options market is very good at pricing implied volatility. Google down 6.18% after hours, up 1.6% for the day, and we can see here that it beat on earnings per share, it beat on revenue, and it beat on total revenue. The problem with Google's earnings, the reason why it got sold, was this right here, Google Cloud revenue. It came in at 8.41 billion. The market was expecting 8.6 billion. And if you miss earnings, if you miss sales, it's not very good. The market is selling you down heavily. It has been a pretty tough earnings season. If you miss EPS, if you miss sales, if you miss both, okay? If your growth drivers aren't growing to what the market expects, you are getting sold. The market is selling. It's a tough market environment. The economy is on shaky legs. Global demand is waning. Inflation is high. You better hit your targets or you're getting sold. You miss EPS and sales, down 6%. And we saw that with Microsoft. We saw that with Google. Microsoft was up after hours, Google was down. It's a very volatile environment right now. Despite what the VIX is doing, it's a very volatile environment. Let's dig deeper into tech. Are tech stocks a buy? So this is the S&P 500 information technology sector earnings growth for Q3 2023 to Q2 2024. Where we are right now, we're expecting 4.8% growth in tech, and then the next quarter 13.4% double-digit growth, 17.4% after that, and 13.7%. So the market is expecting earnings to grow over the next year, over the next 4 quarters. Technology right now is looking like a buy based on these earnings, assuming the companies do go out and hit it. This is the segments in the tech sector broken down. We see that the majority of growth is coming from communications equipment and software. IT services too is seeing some growth, and we are seeing negative revisions in semiconductors as well as electronic equipment, instruments, and components. Yes, you want to be in communications equipment as well as software. It seems these continue to be the growth drivers for technology, and they have been for a while actually. That being said, is the S&P 500 cheap as a whole? This is the S&P 500 forward 12-month PE ratio. You can see here we got the 5-year average and the 10-year average, and right now we're sitting at 17.7, which means PEs are pretty cheap at the moment. PEs are pretty good. Market is looking pretty cheap, and I would say that the market is probably a buy right now. We are sitting at about the 10-year average, just above the 10-year average, definitely below the 5-year average. I think it's a great buy, and I have been buying, not necessarily S&P 500, I've been buying NASDAQ. Based on forward earnings, I think the market is looking very, very good and very, very well priced, all things considered. So stocks may look attractive, but does that mean we will go lower? And this is the equity options put and call ratio. And you can see here that we've had a massive crush in the put and call ratio. And what I think this is a lot of people who were sitting on the sidelines, they're now just joining the bulls, looking for market rally, looking for the seasonal factors to kick in. Now let's have a look at some unusual options activity. And it's the same culprits every day, week after week. We have the QQQ, IWM, and the SPY producing some pretty big volumes right here. Again, very equal on the QQQ in terms of puts to calls, where we have seen a lot more puts than calls in weeks past, especially in September and the start of October. The IWM continues to have just large amounts of put volume, and I think this is actually put sellers just trying to collect premium. And then the SPY, so we are seeing a leveling out of puts to calls, but everybody keeps piling into the big names: NVDA, Meta, Microsoft, Amazon, Alphabet, Apple. Literally, like, this is the Magnificent Seven plus Tesla. Big tech continues to be the driver of, I think, volume, volatility, and price movement this week. Google actually had a lot more calls and puts as well, which is very, very interesting considering how they ended up at the end of the day. It was a fairly low volume day though, and again, like we said, we saw a lot of calls, and that could be just the the put call ratio. Like we said, it was getting crushed. I wouldn't say getting crushed, but a lot of people that were sitting on the sidelines could be just looking at the bull case and saying, hey, like, tech is doing really well. Google's earnings weren't as bad as they were. Microsoft earnings were really good. Meta's probably going to produce good earnings. Same with Amazon, based on what Microsoft did with their cloud segment. Probably going to see pretty good earnings, and it bodes well for a year-end rally. So I guess that's the thesis. That's why a lot of people are loading up on calls right now, particularly January calls. I was diving deeper into the options chain, and there was a lot of premium for January 24. So stocks may be cheap, momentum may be on our side, but how healthy is the market? If you look at the S&P 500 stocks above the 200-day moving average, only about 30% of stocks are above the 200-day moving average, which is a pretty low figure. Is this bullish? Is this bearish? You could say that a lot of stocks, more stocks are being sold than are being bought, and the market is looking structurally not that strong. Having said that, we have to dig a bit deeper, because there's always two sides to a story. This right here is the major averages, the major indices. They are actually making lower lows, but the downside breadth indicator, the McKellen oscillator, is actually making higher lows. So there's a bit of divergence right there, and pretty much what this means is that most stocks are actually making higher lows in terms of compared to what they did in August, September, October, whereas indices are making lower lows. This could be a sign of just implied volatility, the options market, as well as dealer positioning. But that being said, market fundamentals, while they may not be healthy, they are on the up and up. So this is the S&P 500 average 10-day returns, and we can see here that starting in this period right here in October, where we are right now, all the way through November and December, the average 10-day returns is very, very bullish. We are entering a very seasonal period, and you can see here that the 10-day average returns just simply increases all the way through October. We have a bit of a rough patch here in November, but then we continue all the way through to November and December, which is generally positive returns over a 10-day period. So this is some more data here, and we can see here that pretty much when we've had a January to October that is positive, however, the August to October segment in that period is negative, we generally have an average return in November of 2.52% and in December 2.48%, for a total return of 5.04%. And that's 15 times it's been positive, 3 times it's been negative, with 3% moves or higher occurring 14 out of 15 times. NASDAQ seasonality. We know that from the October low up until year end, NASDAQ normally returns 9.5%, 88.5% of the time, with the highest ever recorded return, 54.5% in 1998. And we returned 13.1%, the high between November and December. Now let's move on to dark pools. We do know that seasonal factors are on our side. We are sort of speculating that a low has been put in, so that the put call ratios sort of skewed towards the bullish side. And this is the S&P 500. This is the last 30 days of trade. One thing I want you guys to note is that in this area right here, tons of buyers came in. If big institutions wanted to short, they would have shorted up this area right here. They didn't. In fact, they were loading up positions in this area. Could these be buys? Could these be sells? It could be either or. What you got to understand that for every buy, there is a seller, and not necessarily a short seller. I do believe, if we do get above these levels right here, we are going to see upward momentum through November and December. December. Looking at the QQQ, very much the same thing. The last 30 days of trade, we saw huge trades coming here, here, and here, okay? And then the market moved up. There were no closed trades. There were no other trades happening in this area, which means these are probably long trades. These trades are probably still open. We did see a couple of big trades coming here. These could be some of these trades closed. These could be some of these trades closing, but the volume over here does not equal the volume over here. The volume here is much larger. So these trades are still open. A lot of these trades are still open. So this is the 3x bull, I believe. Again, we saw a huge trade coming here, the 9th biggest trade. Then we rallied. We saw a trade coming here. This could have been a short seller, but price did move down. Now we did see another huge trade coming right here, and probably part of this trade was closing off all of this, as well as maybe some longs entering right there, because this trade was significantly bigger than the trade that happened up here. Thank you so much, guys. If you like this video, please give me a like, comment, share, subscribe. Catch you later.